otherwise we'll just get rid of it. All right, guys, so this is going to be the weekly Q&A. This is the disclaimer. I'm not going to read it, but you know what it is. All right, so I'm going to go over some of these patterns with you guys. Like I said before, I wanna have 1 to 2 weeks of just strictly questions, and then 1 week out of a month, one day where we're just going over new information. So today we're gonna go over some new information. I think we went over new information last week too, but it's fine. So there's these double tops, double bottom kind of patterns. All right. Now, out of all of these patterns and there's M pattern, and there's a W pattern. Now, a W pattern is a bullish pattern. M pattern is a bearish pattern. From these patterns, right, the W pattern or the double bottom pattern is a pattern that I really like to use a lot. It works very well, especially on the 15-minute or a longer time frame. Also for swing trading, this is a very good pattern that you can use. Okay, but I use it with the Bollinger Bands. Okay, so it looks something kind of like this, but you want to use it with the Bollingers, and it'll give you better confirmations. Now, if you're looking for W patterns like this, there's a lot of patterns that you can come up with. For example, this is an uptrend, doesn't really look like a W pattern. So it's very easy to deceive the eyes if you're just using price action to identify these patterns, and you can get caught in basically the wrong pattern. Okay, and we're also going to go over trading styles, because a lot of people are getting confused if they're a scalper, if they're day trading, and what they should be looking at. So I want to re-go over this. I don't remember if I went over this in the past, so that's why I wanted to kind of break this down again. All right. So does anyone have a question so far? So I have Hangout open. Just if you guys get confused anywhere, let me know. All right. So Bollinger Bands, all right? So basically, first we're going to start off. I'm going to explain what Bollinger Bands are. Then I'm going to explain the W bottom pattern, because and I use Bollingers a lot. Bollingers are a volatility-based indicator, and it uses the standard deviation. Same formula that implied volatility uses, right? Standard deviation of 1, which is 68%, right? So the middle band has the 20-day simple moving average by default. The upper and lower bands, they have the standard deviation. There's standard deviation 1, standard deviation 2 positive, and then standard deviation 2 negative. Let me just kind of lower band and upper band. I'm just going to change it to the same color so you guys can kind of see it. Let's look at Tesla. Okay, so this is how Bollinger Bands actually kind of look like, right? So you have the simple moving average in the middle, right? So from that middle line, you have, this is the +2 standard deviation and -2 standard deviation, right? So depending on how much volatility the stock has, these two bands kind of move away from the simple moving average as the stock price is kind of moving in whatever direction, right? Now, the simple formula to trading using these is to look for these bubbles. All right, can everybody see this? I'm going to kind of zoom in. I just don't want to zoom in too much. Is to kind of look for these bubbles. All right. So what happens with Bollinger Bands is whenever price action is really moving very close to the simple moving average, right? Such as like this move that you guys see right here, right? This is telling us that right now there's no volatility in the stock, and the volatility is about to start pouring into the stock. Okay, I wanna say this, even though you guys can see that there is like a breakout happening right here. You have to remember that Bollingers are not a directional indicator. Okay, when the stock starts moving in a particular direction, yes, the bands will start to kind of expand like this, but this doesn't really tell you which direction to go for. I mean, it's kind of pretty obvious, but I just like to put it out there because a lot of people tend to say, yeah, if Bollingers are expanding, I know to get called, but no, it's you have to look at price action. All right, so whenever the bands come very, very close to one another, okay, that means the volatility in that particular stock is slowing down. All right, and then when they start to expand, right, you start to see these bubbles. That means that the volatility is coming in. The stock kind of breaks out of that particular the -2 standard deviation or positive standard deviation. You don't need to really remember that. I just remember it because it was in IB a lot, and I read about that. So the upper and lower band is something you can remember. So whenever it breaks above or below the upper or lower band, which is the purple line, that's telling you that the stock is moving faster than the anticipated volatility of the stock, right? So it's telling us, in theory, that there's a 68% chance that the stock is going to stay within the purple line, right? So when the stock starts moving outside of that standard deviation line, it gives you more volatility. The premiums jump, and you want to look for the volume as well. So let me just add that. Okay, so whenever there's a breakout happening, right, with Bollingers, you guys will always see that. If you guys take a look right here, there will always be volume. Volume will increase very, very dramatically. Like it will go from almost nothing to 2 or 3 times the volume that it was trading, and then we kind of break out. Okay, you want to use this on a longer time frame. You can use it on a 5 minute, but I wouldn't really go on a 1 minute and start using it. It'll just get a little too hectic. For example, let me show you. Right, it'll just get way too much, and the general idea of trading, even Bollinger's or VWAP, is that as long as whatever direction, like let's say the stock breaks out towards the downside, as long as the price action continues to hit the lower band, it's telling you that it's a solid downtrend, right? But on a 1 minute chart, it's going to take one candle for a strong reversal, and that's it. Then that move is kind of over, all right? So use it on a longer time frame. And when we start getting moves like this, okay, meaning price action is coming very close to the band, but the band has now kind of moved away from price action. Like you guys see here, it's still touching. And then once we have that pullback and it starts to come back, the band is way further away from that volatility, meaning the volatility has caught up, but the price action is not as volatile as it was before. So that move now is kind of over, and we might see a reversal. All right, so Bollingers are very good at determining when that volatility is slowing down, but you can't just use it alone. You have to look at volume. Volume is slowing down, or on the reversals, if volume is starting to pick up on the upside. So these are all the patterns that you want to start picking up on this, but have this on a longer time frame. I use this mainly on a 15-minute chart. Okay, so what I like to do is on a 15-minute, if pre-market we're moving like this, for example, if you take a look at Tesla right here, right? If pre-market the bands come very close to one another at the open, I'm not going to get into Tesla until it breaks out of this. Until it kind of breaks out in this particular manner, right? We start pushing out, we have an increase in volume. That's when you know that, all right, this stock has a lot of volatility coming in. It's breaking out of a key level, and it's been kind of consolidating here, and now there's a lot of volatility in the stock, and there's a lot of volume coming in. At this point, right, a lot of people who are using Bollingers who trade options, they start jumping in here as well into that particular stock. So if you're looking at the right strike prices, the volume in that strike prices starts increasing as well, and the premiums start to jump up. All right, does anyone have a question so far? All right. Right. So again, you have the upper bands, lower bands, and then the middle bands or your 20-day simple moving average. All right. This is something I want to kind of remind everybody, and this is a mistake a lot of people use. You guys see this 20-period simple moving average, right? You'll hear a lot of people say simple day moving average, right? It depends on the time frame you're on. Okay, you remember that. If you're on a daily chart, this number will be for the 20-day, 20 candles, the 20 daily candles, right? If you're on the 5-minute chart, it'll be that data that you're getting is going to be for the previous 25 candles. All right, and if you add, and there's a lot of times when you switch from viewing, I know this is kind of deviating from what we're talking about, but since we're on the topic, because a lot of people end up using this information wrong. If you guys are watching, right, if you have, okay, so if we add